Hi, I'm Francois Trahan. Welcome to the Macro Specialist Designation program. Let me take you through a brief introduction before we dive into the content of the program itself. Let's kick it off. Managing money has been challenging in the era following the global financial crises. Now, by challenging, what I'm referring to is the sharp deterioration in the percentage of managers that have been able to beat their benchmarks. Most underperform year in and year out nowadays. A lot of excuses have been put forth to explain this dismal performance, but one that never comes up is the growing influence of macro forces on financial markets. In this introduction, I'm going to show you how this is the chief culprit behind this phenomenon. The bottom line is that today's professionals are not trained in macro. They are trained extremely well, I might add, in micro or balance sheet analysis. This lack of macro knowledge is what led me and my team to create the M²SD program. Our goal is to try and fill the gap in financial education when it comes to macro. Showing the importance of macro's influence on financial markets and equities in particular is really not that complicated. The S&P 500's return has been correlated with leading economic indicators like the ISM Manufacturing Index for a long time. This chart shows that the two series have mostly moved in sync since 1948. Now, this makes sense since they are both official components of the Conference Board's leading economic index. In fact, the S&P 500 has been in the LEI since it was first created in 1937. So it has survived every revision to the index since. Now, we consider this to be undeniable proof of the macro relationship between the stock market and the economy. I've been publishing macro research on Wall Street for about 25 years now. And time again, I've encountered folks, and by folks I'm referring to financial analysts and portfolio managers, that believe that it is idiosyncratic forces or company-specific influences that matter most to equities. Now, while I've never met Warren Buffett in person, he once said that forming macro opinions or listening to the macro or market predictions of others is a waste of time. In some ways, I don't blame Mr. Buffett, as Wall Street strategists are notorious for being terrible at forecasting the stock market. Still, that is an indictment on the people, not the process. That is a group that is just not very good at macro. Candidates of the M²SD will learn in the program that stock price movements are largely explained by macro events. In fact, in the last few decades, the influence of macro forces versus that of idiosyncratic risk for the typical stock in the S&P 500 has become even more dominant. Macro forces were not always this dominant on stock prices, and one of the variables that played a role in this is the average holding period for stocks. Back in the 1960s, the average holding period for stocks was over 8 years. In that world, being well-versed in fundamental analysis or bottom-up research is going to be absolutely critical. Now, all that said, the investment backdrop has changed drastically since the 1960s. Holding periods for the average stock are less than a year nowadays. That is just not long enough to unlock whatever company-specific advantage a stock might have. In that world, macro will likely dominate stock-specific influences. The problem with today's industry is that the education that leads to a career in finance has not evolved with the times, and it remains largely geared toward fundamental research, unfortunately at the expense of macro. Let's look at a concrete example on the influence that holding periods can have regarding the influence of macro. The chart on this slide shows the S&P 500's performance in two distinct periods, both lasting 8 years, or what was the average holding period back in the 1960s. Now, one period starts on January 1st, 2008, and the other one starts on January 1st, 2009. Obviously, the period starting in January of 2009 had better returns, but the one starting in January of 2008 also saw sizable gains over 8 years. The point here is that the longer the holding period is, it will mitigate the impact that the business cycle has on stocks. In this particular case, the global financial crises. On such a long time frame, events like that are going to be dulled somewhat in the eyes of investors. Now let's look at how this relationship changes when we use today's holding periods, which are down to less than a year. We are again using two charts of the S&P 500 with the exact same start dates, January 2008 and January 2009, but this time only looking at their performance over a one-year holding period, or what is commonly seen nowadays. The contrast is daunting. The S&P 500 lost roughly 38% in calendar year 2008, while it gained 23% in calendar year 2009. The reality is that both 2008 and 2009 were macro-driven markets. The former, a year where markets were pricing in a recession, and the latter where they were pricing in a recovery. Now, most investors were myopically focused on earnings and had real issues navigating this period. The point here is that the influence of macro is muted when holding stocks 8+ years on average, but it is completely dominating fundamental analysis in today's backdrop where holding periods are less than 1 year. The drastic change in equity holding periods has enhanced the influence of macro on stock price movements, and this at the expense of fundamental or company-specific effects. Truth be told, it's not that difficult to show that macro forces matter more to financial markets today than they ever have. Let's dive into the specifics that have driven a lot of these changes in the financial industry. Simultaneously, we will show that it is imperative for investors to incorporate macro analysis into their investment framework. Another factor that has enhanced the impact of macro on equity markets is the slower average growth rates seen in the economy in the post-GFC era. The world has been awash with growing structural headwinds, and this started a decade before the pandemic took place. We refer to this new macro backdrop as the era of uncertainty, and it's a topic that we will explore in detail throughout the program. One consequence of slower economic growth has been an increase in stock correlations within equity indices. This is not a good thing for active management, as it implies that the average stock is more influenced by the broader market than it used to be. And this comes at the expense of company-specific effects, which is the bedrock of financial education. In essence, macro matters more, fundamentals matters less when it comes to picking stocks nowadays. There's always been a strong relationship between the level of economic growth and intra-stock correlations. This helps explain why almost all of the stocks in a given equity index tend to decline in the run-up to a recession. While this concept might sound foreign to a pure bottom-up analyst, it is actually not that difficult to prove. This chart shows that there exists a clear inverse relationship between the global PMI, so a proxy of economic growth around the world, and intra-stock correlations in the S&P 500. The implication here is that the slower the economy grows, the higher correlations will be among stocks. Worded differently, the slower the economy grows, the greater the influence of systemic risk on equities. Now, the opposite argument holds true as well. Lower intra-stock correlations can be seen in an economy that is accelerating, making it a better backdrop for stock picking. All that said, knowing that the economy is not growing as rapidly as it used to, on average at least, tells us that systemic risk, or macro, will inherently matter more than it used to, and vice versa for idiosyncratic risk or company-specific factors. Let's go back to basics here for a second. One peculiarity from the era of uncertainty, or the period following the global financial crises, is that GDP growth has grown much more slowly on average than it had in prior decades. This is largely due to structural issues, and these have only been made worse by the pandemic. Now, a slower economy has resulted in less companies growing rapidly and a much more polarized equity market. The end result is that those few companies growing rapidly have gotten almost all of the attention from investors and seen their share in the index grow. Now, just to be clear, a concentrated market is not an easy one to outperform. Again, all of this is a byproduct of macro forces. There are different recipes to success in this business, and I'm not claiming that macro is the end-all be-all. That said, it is undeniable that it is playing a key role in the working lives of portfolio managers, whether they choose to embrace it or even just admit to it. Let's recap here. The economy is growing more slowly, and that has resulted in less S&P 500 companies being able to grow rapidly. The end result of this is a huge gap between winners and losers, and an index that is now highly concentrated in just a few names. The FANGs, for instance. This poses real challenges for portfolio managers. This chart shows that the lower the number of rapidly growing companies there are, the lower the proportion of portfolio managers beating their stock benchmarks there will be. This is a great example of how macro forces are influencing, really changing the entire money management industry. The bottom line is that slower economic growth raises systemic risk and creates a more difficult backdrop for investors. And this is happening at the expense of idiosyncratic risk or company-specific effects. The chart here shows the percentage of portfolio managers able to beat their respective benchmarks in a given year. The last decade is not exactly an endorsement for active management. To be clear, I'm still a believer in active over passive management. I'm just going to point out that there's been a tectonic shift in the investment landscape, and changes in macro forces is the main culprit behind this new backdrop. Pointing the finger elsewhere does not help resolve the issue. So think of the M²SD program as an opportunity for those early adapters willing to embrace and in turn benefit from this macro-driven era. Let's shift gears here and try to get a better understanding as to why economic growth has slowed so much in the last decade. If this is a temporary phenomenon, then maybe being a stock picker or a fundamental investor is still the way to go. If instead these changes are structural in nature, then the entire investment industry needs to adapt to these new realities, needs to find new tools to help shore up their performance. While there are a host of reasons for the secular downward shift in economic growth, at its core is the dearth of leverage in the system. Specifically, the U.S. consumer, which makes up nearly 70% of GDP, has altered its behavior following the financial crises in 2008. Worded differently, consumers no longer have tremendous appetite for credit and debt. There's also big changes taking place around the world that have implications for U.S. economic growth. One example is the end of the investment boom in China in the mid-2010s. So in short, the global economy can no longer count on the structural forces from China and the U.S. that helped enhance the world economy across several decades. The end result of this new normal is slower economic growth on average and less stability. Unsurprisingly, this new structural dynamic has had a number of ramifications on the investment backdrop and equities more specifically. Few investors can recall the environment between 1965 and 1980, a 15-year period in which the equity market made zero progress. Massive structural headwinds, such as rising inflation and interest rates, contributed to a cyclical boom-bust cycle of sharp rallies and violent corrections over the course of 15 years. Now, the macro backdrop following the global financial crisis has also been plagued by structural headwinds, which have brought about a similar type of cyclical boom-bust markets. Think about negative rates in the European region in 2014, followed by the Greek debt crises, trade wars throughout 2018, the inversion of the yield curve in 2019, and the pandemic crisis that reshaped the investment landscape once more. For the first time since the 1970s and 80s period, inflationary pressures became a threat to the economy, and central bankers waited too long to raise rates. We have yet to see the full effect of the Fed's mistakes in calling inflation a transitory phenomenon in the wake of the pandemic crises. Now, the bottom line is that crises are becoming more common, again, enhancing the importance of macro on financial markets. In a world where financial markets have clearly become dominated by macro forces, the CFA program, the mostly bottom-up CFA program, remains the standard for a career in the financial services industry. Fundamental research is still important, but knowing how to analyze balance sheets is no longer enough. It does not prepare investors for today's market realities. How is it that money management's performance has deteriorated so drastically over the last decade, just as the number of CFA candidates has grown so much? If what was missing was more knowledge of fundamental research, well, performance should have improved, but it is not. Almost 70% of professional investors we surveyed a few years back told us that investing had become more difficult, more challenging. I guess this is not surprising given how few portfolio managers are able to beat their benchmarks nowadays. Now, the industry has come up with a myriad of explanations as to why performance has been poor, and they've tried a number of things to enhance results. Some have invested in big data, others in artificial intelligence. We've seen many departments restructured entirely away from generalists and towards specialists. Meanwhile, there's been a growing trend toward factor-based investing. Now, truth be told, none of these changes have made a meaningful difference in investment results. One thing we've not seen is anyone investing in educating their staff on macro. The industry has yet to clue in that most of their problems stem from the dominating influence of macro forces on financial markets. Investing in a structurally slower economy is challenging for investors. It becomes harder to differentiate the winning stocks from the losing ones in a backdrop dominated by macro, where systemic risk overshadows the fundamentals of a company. This chart shows the correlation between economic growth and the performance of the money management industry. Indeed, the number of active managers beating their benchmark is very strongly tied to the ebb and flow in the number of S&P 500 companies growing rapidly. Managers clearly do better in a strong economy. The sad reality is that it's become harder for portfolio managers to beat their benchmarks because the economy has slowed. This is but one piece of evidence, but it shows that macro forces play a bigger role in performance than most believe. Macro forces have always played a role in financial markets, but portfolio managers did not have to worry about them nearly as much when economic growth was strong and stock picking opportunities abundant, such as in the 1990s, for instance. The reality is that the era of uncertainty, or again, the period following the global financial crises, has changed the investment landscape and made systemic risk a more prominent condition. Investors simply cannot afford to ignore macro anymore. In the 2010s, only 32% of US fund managers have been able to beat their benchmarks in a given year on average. This is not exactly a statistic anyone involved wants to brag about or even discuss. The financial industry is not known for being humble, and few are willing to admit that poor performance is behind the outflows seen in active management. It's easier to blame the rise in ETFs as an explanation behind this phenomenon than to admit something is just not working. If anything, the rise in ETFs is more likely a consequence of the poor performance of actively managed funds than the reverse, and macro has had a role in all of this. Let's explore why the industry has been so poor at handling macro events. Let's take a look at how investment research is structured for the typical firm. Most Wall Street banks line up their research roster according to the Institutional Investor Magazine categories, also known as II Magazine. Analysts are ranked by institutional clients every spring, and the results of this survey are published every fall in II Magazine, and banks use this information in their marketing. Now, there's three categories that are connected to macro. There is economic analysis, Washington research, and portfolio strategy. So on the surface, there's plenty of macro research available. That said, economists mostly focus on data that's already been reported, like GDP. We will cover this topic in detail in the M²SD, but economic analysis is not very forward-looking. It won't help you forecast stock market trends. Washington research mostly focuses on fiscal and monetary trends, so some of that will be helpful. Portfolio strategy is the one category that is most useful for financial market analysis. I spent my career competing in that category, and I managed to rank in the top 3 on 17 different occasions, and 10 of those as the #1 portfolio strategist on Wall Street. While portfolio strategy research is where we should find the highest macro content, in reality there's very little, at least very little that's worthwhile. Most Wall Street strategists, when setting their price targets, follow momentum in the stock market rather than make true macro-based forecasts supported by material facts or historical probabilities. This chart makes that point loud and clear. It reveals that Wall Street strategists' targets follow the S&P 500 by a few months. In other words, most of the portfolio strategy research published on Wall Street is informative at best, but it is not predictive. Let's examine one example of a major macro event, the start of the pandemic in the spring of 2020, and look at how Wall Street strategists reacted to it. In the midst of the COVID-19 outbreak, again, one of the biggest macro events of the last decade, most strategists lowered their 2020 year-end targets after the decline in the equity market, mind you. And 5 of them actually suspended their S&P 500 targets for the year. Now, if you look at the note at the bottom of this slide, it says, "Forecast suspended due to uncertainty over the coronavirus outbreak." This was the time in which investors needed strategists the most to provide guidance about where the economy was headed and, most importantly, how to position their portfolios. Forecasting macro trends is the job of a portfolio strategist by definition, yet 5 of these specialists threw in the towel when uncertainty overshadowed financial markets. Think about this. These are the macro specialists that are being compensated to provide forward guidance for the S&P 500. How is it that they lost enough conviction in their own framework to suspend their targets? Most in the industry, including macro strategists, are trained to analyze balance sheets and income statements in order to come up with an earnings target. This is one of the biggest frustrations that comes with being a top-down practitioner, and it's the lack of appreciation for macro in our industry. It's no great secret that earnings dominate the typical research investment process on Wall Street. Look no further than the content of the CFA program to understand the role that earnings play. Now, remember that nowadays, a CFA is considered a benchmark for a job in the finance industry. Macro, on the other hand, comes in and out of favor. Investors seem to care most about macro when a crisis is at hand or when a macro issue dominates the media and investor mindshare. The problem is that because analysts spend most of their time trying to forecast earnings, a huge macro event like the one we experienced in 2020 will throw off their financial models. This explains why even some strategists chose to suspend their targets. Saying that macro is underemphasized in our industry is not trivial. In fact, in a survey of professional investors we did a few years ago, the lion's share of institutional investors admitted that fundamental analysis is the most important part of their investment process, while only 20% of clients focused on macro-related analysis. This is important because market multiples, or PEs, are really just an expression of the macro backdrop at the end of the day. Now, one topic we cover in level 1 of the M²SD program is that PEs tend to be more influential with equity returns than earnings nowadays. PEs tend to behave more like leading economic indicators and are therefore able to capture macro influences, including future trends in earnings. Had portfolio strategists emphasized PEs rather than just earnings in the spring of 2020, perhaps they would not have had to suspend their targets. Macro-wise, it was clear that all this stimulus would eventually lift the economy. This is one tool that MSD candidates will learn to master in level 1 of the program. There are many recipes to success in this industry, and while macro is the MSD's focus, it is only one option. Truth be told, however, the main tools that most investors rely on, such as earnings forecasting models, can be myopic at times and lead them astray in some backdrops. This is especially true during major macro events, which are often a byproduct of Fed easing and tightening cycles. Unfortunately, today's typical investor has little macro training and even less education on the influence of rates or monetarism. Academia, when it comes to finance, education is centered around the understanding of accounting and balance sheet analysis. In other words, influences that matter to earnings. The CFA program reinforces this even after someone's academic years. It is a bit puzzling that some investors ignore or reject macro altogether. Most will recognize the impact that the Fed or other macro forces can have on the economy, but then refuse to make the leap to stocks. At the end of the day, stocks are leading indicators of the economy. An index like the S&P 500 is just a discounting mechanism for future GDP growth. This chart shows that the S&P 500's return leads real GDP growth in the US by about 6 months. Unsurprisingly, the low point in equities seen in major bear markets of the past is typically about 6 months before the depths of a slowdown or recession. Now, it is bizarre that some in the industry have failed to embrace this concept. The S&P 500 is one of the 10 variables included in the Conference Board's LEI index. These series were picked specifically because they are the very best at forecasting GDP. And once more, the S&P 500 has survived countless revisions to the LEI since it was created in 1937, only one of 3 variables to have done that. So reality check, an opinion on stocks starts with an opinion on the future trajectory of the economy. While most investors still see macro as something that only requires a periodic focus, its influence on stock prices has been growing over time. Slower economic growth around the world has led to more and more macro events and a growing correlation among stocks. In essence, knowing which company to buy based on idiosyncratic risk has lost some of its importance across the decades, just as equity markets have seen their intra-stock correlations increase. In other words, the rising influence of systematic risk or macro influences. So why should you do the MSD program? Well, this program fills the macro void that is not covered in academia or other financial certification programs such as the CFA. The MSD was designed to give analysts the skills to analyze and, most importantly, to forecast financial markets by using a top-down framework. The MSD will prepare analysts to identify major inflection points in the business cycle and financial markets and learn to position portfolios according to the different phases of the economic cycle. There are 3 different levels in the MSD program. Each level is meant to provide the essential building blocks of applied macro concepts in a practical investment setting. Level 1 focuses on the understanding of leading economic indicators and anticipating inflection points in the business cycle and financial markets by the same token. Students of the MSD will learn the different phases of the market cycle and how to position portfolios accordingly. Level 2 dives more into the structural backdrop of the global economy and how the new normal has altered investing. We'll cover global asset allocation and sector leadership in extreme detail. All right, last but not least, Level 3 marries macro with micro. Students will learn to build a stock selection model with fundamental factors. Think of it as a top-down / bottom-up strategy. We will cover different valuation metrics and their pitfalls and the do's and don'ts of stock selection. Level 1 of the MSD is broken into 4 blocks, and there's 18 chapters in total. please take a minute to review the different chapters in the table on the left. Now, in Chapter 1, we will introduce each of these chapters and focus on one key macro lesson to take away from it. Specifically, how could the knowledge of macro have helped investors benefit or even profit across many historical real-life examples? Something we will cover in Chapter 13 is the misunderstood relationship between PEs and interest rates. Market multiples have long been misunderstood in the financial industry, and this largely stems from what's taught in academic finance and/or economic courses. Standard academic textbooks, such as the Handbook of Fixed Income Securities by Frank Fabozzi, for instance, typically state that lower rates have a positive impact on price-to-earnings multiples. And this is actually not always the case. In realities, PEs respond to interest rates in some periods and to the business cycle in others. Level 2 of the MSD is broken down into 3 blocks, and there are also 18 chapters in total. Please take a minute to review the different chapters listed on the table on the left. In Chapter 19, we will learn about the era of uncertainty, or the period following the global financial crises, and how the perceived visibility of the Great Moderation era is long gone. Structural headwinds are now more or less a constant feature of the economic landscape. Now, the Great Moderation era and its strong GDP growth favored value over growth investing for decades. This helps explain why textbooks and investment research is so skewed to the value universe. We were all taught at some point that low valuation is the key to success in money management. Now, post the global financial crises, the style cycle has been flipped upside down, with growth now dominating value, and valuations have seen a lot of firsts or historical moments since then. In that sense, the era of uncertainty has not felt right for many investors who were educated for a different world altogether. Level 3 of the MSD is broken down into 3 blocks, and there's also 18 chapters in total. Please take a minute to review the table on the left that lists all of the chapters. In Chapter 46, students will learn that valuation factors are largely influenced by the business cycle. So for instance, equity valuation metrics tend to perform best when leading indicators are trending higher. In contrast, valuation metrics that are focused on the entire financial structure of a firm, like enterprise value for instance, will generally outpace other valuation metrics when leading indicators are losing steam. This is just one example of how analysts can marry macro with micro, where understanding the business cycle and its different phases can enhance the efficacy of stock picking factors and ultimately improve performance overall. So who will benefit from the MSD program exactly? The answer is anyone in the financial services industry, irrespective of what your role is. That's right, whether you're just coming out of school and looking to break into the financial industry, or you're an established trader, a banker, a wealth manager, a sell-side analyst, or even a fixed income portfolio manager, and the list goes on. There is not one area of financial markets that is immune to the influence of macro forces. Anyone in the financial industry will benefit from gaining a macro edge on their competitors. At the end of the day, the MSD is about teaching candidates how to incorporate this top-down knowledge into an investment framework, ultimately to benefit your career track and performance. Here's a different way to think about who will benefit from the MSD program. And the answer is anyone looking to gain a knowledge advantage on their peers. This graph is an illustration of the traditional knowledge curve, which is represented by the blue line. In theory, we start our careers fresh out of school with little experience or knowledge, but with a ton of stamina. Now, in contrast, as we approach retirement, our experience and knowledge are plentiful, but the stamina curve starts to shift downward. The prime years of a career is essentially where these two lines meet, the intersection of having many years of experience where knowledge is high, but with energy that is still plentiful enough to put that experience to work. The red line represents the traditional knowledge curve after successfully completing the 3 levels of the M²SD. In essence, the M²SD shifts this traditional knowledge curve upward, meaning students will reach a higher level of experience and knowledge in the earlier years of their career. Think of what this means from a competitive standpoint. Showing up to an interview with the same level of knowledge as someone who may have already bucked 5, 10, or 15 years in the workforce. This is where the famous phrase, knowledge is power, can be applied. Academic training in finance is generally focused on balance sheet or fundamental analysis with little to no coverage of top-down macro forces. The popular CFA program, which has become the standard credential for careers on Wall Street, is also heavily skewed toward fundamental-based stock selection and portfolio management. The M²SD curriculum is designed to fill this void left by academia and current financial industry certifications when it comes to macro principles and to apply them in financial markets. The key concepts in the M²SD are taught over 3 levels of study, followed by a certification exam for each level. All 3 levels can be completed in as little as 18 months, as exams are offered 5 times per year. And candidates who pass the exams of all 3 levels will receive the M²SD designation. Most schooling and training geared toward professionals entering the financial services industry is focused on fundamental, bottom-up analysis with little top-down macro. Successful M²SD candidates will emerge with enhanced knowledge that tie in the influence of macro forces on financial markets, stock selection, and portfolio design. This macro knowledge base will ideally complement the candidate's current understanding of fundamental equity analysis and improve their ability to forecast financial market trends. The ultimate goal is for the successful candidate to implement these new lessons into their current framework in an effort to ultimately improve their performance. Let me summarize with 4 key points. Number 1, stocks have always been influenced by macro. Again, the S&P 500 was added to the Conference Board's leading economic index when it was first introduced in 1937, so this is not a new story. Number 2, macro's influence on stocks has increased across the decades. Some of this is due to globalization and a host of issues, but the main driver is the shorter holding period for stocks. Number 3, today's financial education is not that different from what we saw in the 1960s, but the market conditions are completely different. It's no longer just about idiosyncratic risk. We live in a world where systemic risk or macro forces play a significant role, and market participants are just not trained for that. And number 4, the Macro Specialist Designation is meant to be a complement to today's financial education. So this is not a replacement for the CFA. It is a program that provides candidates with the macro knowledge necessary to navigate the 21st century's financial markets.